Hey guys, I'm Jeremy Iannuzzelli, and this is what school should have taught you. This week, we're going to air one of the most requested podcasts at the time of the year where it's going to help the most about CGT. This is from when I was on the Pizza and Property podcast with our good friend Todd Sloan. There is a ton of great info on this episode, and it's been one of our most requested episodes to date. So instead of reinventing the wheel, I thought we would share one that's already spinning perfectly. Enjoy the episode, and I will see you back in my studio next week.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want. Jeremy Iannuzzelli, how are you, mate?
Very well, mate. I'm in your home state, City of Churches.
Yes, you are.
It's a lovely weekend, and it's beautiful weather. We've been granted some really beautiful weather.
Mate, I'm just constantly asking myself if I'm saying your name right, because we did a Sydney live at the start of this year and I was like, yeah, I've nailed it. It's Iannuzzelli. And then you're like, no, it's not, Todd. Have I got it right this time?
Yeah, you're getting it right. I'll give it a 95 out of 100. Iannuzzelli, but
Iannuzzelli.
We'll say that it's a pass mark, 100%.
I'm going to impress you one day, mate, and I'll just nail it completely 100%. All right, so today we've got a topic which no one really enjoys, but I think it's going to be something that people are going to get so much from, because the enjoyment factor is potentially towards the end of the episode when we're talking about reducing CGT. But for anyone that's newer at property investing, they really going to want to understand, first of all, like what it is, how it applies, when it's triggered. So I think this is going to be an episode that's potentially, if it's really received correctly, going to save people a truckload of money, but also give them an understanding to help bolt onto their strategy moving forward. Because sometimes you might be able to make 100 grand in property, but it doesn't mean you actually get to keep that whole 100 grand. So before we get into all the questions, mate, can we just start with the simplest one? What is CGT?
Capital gain tax, or referred to as CGT quite commonly. It's a tax that you pay on the gain that you've received when selling an investment, whether that's property, shares, could be investments being held from gold point of view, hard metals, could be investments if you've got a car investment that you're making. It's pretty much any investment that you're willing to show it as a cost base that can't be shown private in nature. There's tax applicable to it, and that tax is applicable based upon the entity that purchases that particular investment and has made that particular amount of profit.
So when you say cost base, what do you mean by cost base?
Cost base is the elements that are involved when purchasing that particular investment. So if we look at, for instance, a share, the cost base would be the purchase price of the share plus any brokerage fee attached to it. If we're talking about property side of things, it's the purchase price of the property plus all the incidental costs that go into purchasing that property, which include that of the stamp duty, which include that of the conveyancing fees, might be inspection reports that needed to be done, could be any renovations that were made to the property during the period of ownership or at the very start, property being purchased in disrepair. So it's all the cost-based elements, all the cost elements involved in purchasing that property in the initial stages or potentially throughout the time of ownership.
Now, you said renovation. I know I learnt that the hard way on my very first reno. I was like, I'm not going to pay any tax this year. I've just spent like $30,000 on this place. I'm sweet. I get to claim it all back on tax. I very quickly learnt that's not how it works. And I got told that it had to be added to the cost base. For anyone listening, maybe doing a reno at the moment, is there anything else that you could kind of expand on down that avenue?
Yeah, so there's a whole bunch of definitions to determine what is a repair and maintenance and what is a capital cost-based item. So a great example I can give you, and it happens quite common, is a hot water system. Everyone says, oh, Jeremy, I've had to put a new hot water system in because it busted the old one. Now, if you repair that old one, and that could be by putting new pipes or a new thermostat, could be just getting it serviced or replacing the element, that's a repair to the existing hot water system to prolong its life. But if you've got a brand new hot water system, for instance, and that hot water system broke, the old one broke, a new one got replaced, well, then that needs to be depreciated. That's part of a cost base of an item, and it gets depreciated over a certain period of time. But if you've now fully renovated a property, then that cost, we need to depreciate that again over the life of each individual asset that's gone into that renovation. And if we don't depreciate it by the time that we sell it, the remaining balance of that, we potentially get to claim that as part of a cost-based element of the property, which therefore goes to reduce our capital gain tax.
Now, I want to talk to you about depreciation schedules and something that I feel not a lot of people are really aware of, but then how a depreciation schedule and your cost base, and there's a payback when you're selling. But before we get into it though, I wanted to ask you about when it's actually triggered, because I think there's a little bit of a misnomer or a myth around that as well. So can we bring some clarity to when it kicks in?
Yeah, so CGT, if from an investment point of view, and I won't confuse people too much because there are other elements to it, but from a capital gain tax point of view, it is triggered when a contract is made. So when the contracts are signed. So not from a settlement point of view. So if you've signed a contract for a particular property to sell it, and let's say you've signed that contract on the 29th of June, then that triggers the capital gain tax. But then people say, well, Jeremy, what happens if my contract crashes, prior to settlement, which might be the 29th of July, but I've done my tax return with you on the 15th of June?
Good question.
Well, great question. We just need to go back and then we need to amend the tax return. And whatever tax that we've paid potentially as part of the CGT, we amend it to take that away. So for anyone out there listening, ideally you want to sign contracts if you're very close to the end of the financial year and there's no risk of losing that particular buyer, of course. You want to be signing that contract and exchanging those contracts after the 1st of July.
I'm pretty sure I actually had this happen once with an investor that was very bullish with the way they negotiated and tried to make it sound like the deal was going to fold, because they kind of got the feeling that the client was actually wanting to make sure everything was done before the 29th of June. And they were like, okay, well now everything's going to fall apart, and tried to renegotiate the deal because they thought, well, this person's not going to get the same kind of benefits for selling it in the next financial year. So let's actually come back and try and like push a little more. End up keeping everything together, but you've just triggered a memory from about 5 years ago for me right now.
Very common, and people do that all the time from a land tax perspective. I know it's not talking about land tax at the moment, but ideally, if you're very close to the taxing date, which is the land taxing date, then you want to kind of push that purchase, that settlement, just after, so you're not getting charged land tax, for instance.
Now, how is it actually calculated? Because, and I've got a little scenario here, just simple numbers. Someone that's earning 100 grand a year. Let's say they bought a property a couple of years ago for 400 grand, and now it's worth 500 grand. Actually, chances are they probably just bought it like 6 months ago for 500 grand. But either way, they've got 100 grand worth of uplift now in the equity. But I wanted to make sure that we were talking about the fact that they earn 100 grand. Because their income actually really comes into how much CGT is payable. Is that correct?
Absolutely. And the entity as well. So a number of variables that come into play: the entity, the income of the particular person who's receiving the capital gain.
Can we say it's in their own name?
In their own name. So nice and easy. He owns $100,000. You bought the property, and for argument's sake, all the cost-based elements that go into the purchase of that property is 400 grand, and all the sale price elements goes into that sale price, which is net 500,000. Because there's things involved like commission on the sale, conveyancing fees on the sale as well, maybe staging costs. So there's a number of elements that go into the sales side, which become as a deduction from a capital gain point of view.
Okay, so now we're already down by 20-ish grand or so?
Give or take. So we'll use that, all that's been taken into account is to calculate our 500,000 net sale price. And all the cost-based elements have been taken into account for our net $400,000 cost base. So if we've got now that $100,000 capital gain, if he was to sell that property before 12 months of genuine ownership from contract date to contract date, then there is no discount applied, which means then he'll be paying capital gain tax on $100,000 of that profit on top of the $100,000 that he's already earned as income. So in that particular case, his net income then becomes 200 grand on his tax return.
Okay.
And he'll be paying tax through the marginal tax rate system on that additional 100,000 that he has earned.
So this is why when people retire and start selling off their portfolio, they don't do it all in one hit.
Correct.
You're better off kind of doing it year to year.
You stage it as much as you can. And ideally, a lot of the strategies that I have with clients from a tax point of view is we'll try to, and if they do decide that they want to sell the property, we'll do it at an advantageous time where their income is at the lowest. So for argument's sake, they might be wanting to start a family very soon, and the property might be owned in the spouse's name, and the spouse goes off work for potentially 1 or 2 years while looking after the little child. It's a great opportunity, if they were going to sell that property, to be doing so at that time, and therefore the tax is going to be quite minimal or at its lowest point that it possibly could be.
Mate, that makes a lot of sense. Okay, and if let's just name this person, let's call him Tim. If Tim had have held the property for more than 12 months, how much does it change things?
So we get this beautiful thing in Australia called a capital gain discount.
Okay.
So by holding a property for longer than 12 months, again, contract date of purchase and contract date of sale, then we have this 50% discount that is a 50% reduction of the profit that is made. So on that basis, the $100,000 income now reduces by 50%. So therefore only $50,000 is getting added on top of his $100,000 wage as opposed to 100.
Okay.
And the good news is that $50,000 that became our discount, that's a tax-free income.
Right. Okay. So there is a lot of extra benefit in holding for 12 months.
Absolutely. So wherever possible, we always encourage clients to hold the properties for long term or at least over 12 months because there is a capital gain discount applied to it.
Now, if someone's holding a property, and this is only going to be not eligible, but applicable, I think, for such a minute amount of our listeners. But if you're listening right now, I want to include everyone in this. And let's say they bought it back in the 70s. Now, I remember hearing from someone once, CGT doesn't apply. Is that correct?
That's correct. So there's a pre-CGT ruling now. We'll have to double check, but just correct me if I'm wrong. I think it's 1984. If a property was purchased and has not traded hands through inheritance or other things, and it was purchased prior to 1984, always held as an investment, it's a capital gain tax-free event.
Is that what George Orwell's book was about?
Absolutely. So it's a capital gain tax-free event. So if you bought a property in 1980, for instance, for $100,000, and today it's worth $10 million, aside from probably paying lots of land tax, there will be no capital gain tax applicable.
Even if it's an investment property?
Even if it's an investment property.
Interesting. Okay. All right. Now, how does this change things? Let's say that Tim, he's got his $500,000 property, he's sold it, and let's say maybe he's had it for more like 10 years, and he's been claiming depreciation on that for 10 years. And let's even say it was a newer sort of property, maybe not brand new, but he's got some good depreciation back on his tax. And if he's earning $100K a year, he's got a decent income. How does that now change things as far as what he needs to pay capital gains tax-wise?
Brilliant. So there's that Division 43, and if you ever see that inside your report, your depreciation is broken up into two parts. Division 40, plant and equipment, which is most of the internal side of things of the homes, your doorknobs and, could be kitchen items such as ovens or cabinetry. And then you got what they call Division 43, which is the actual building allowance itself. That's the depreciation of the slab, the bricks and mortar, the roof, the more structural side of the property itself. Now, in this particular case, Tim's been able to claim that Division 43, that building write-off over a number of years. He's received the tax benefit based on his marginal tax rate on that amount.
So plant and equipment is Division 40 and the building is Division 43?
Correct.
Right? Okay.
Correct.
Yep.
So that's what you'll see in your tax return, plant and equipment and capital works building write-off. Tim's been claiming, and we'll use this for argument's sake, been claiming $10,000 a year for the last 5 years. Let's say for argument's sake, 5 years.
Yep.
That's $50,000 worth of Division 43 that he's claimed. Now, for argument's sake, on that $50,000, his tax rate is 40%.
Okay.
So he's been getting $4,000 a year in tax benefit through the duration of that time.
Okay.
So
Yep.
so we've got a good amount. We've got our $20,000 now worth of tax benefit.
Yep.
When he goes to sell that property, he needs to add back that $50,000 that he has claimed as a tax deduction. He needs to add back the building write-off. So a lot of people say, well, Jeremy, why am I claiming something?
That's what I was just thinking.
To add it back.
Yeah.
I didn't create the rules, unfortunately. We interpret the rules and then we follow the rules.
Yeah.
So we do add back that $50,000. Now people say, well, Jeremy, I've got $20,000 back. I now need to pay that $20,000 as a one-off hit. Not necessarily. This is the kicker. We got a 50% discount. So while adding that $50,000 back to, say, for instance, the cost price or the sale price, depending on which side of the equation you look at, we're essentially increasing the sale price or we're decreasing the cost price. So I'll just say that again.
Yeah.
We're increasing the sale price or decreasing the cost price to account for this $50,000 add back. But then we get a discount. We get that 50% discount. So if all things remain the same, he's received a $20,000 refund in the last 5 years based on that Division 43, but he's having to pay back $10,000 of that through the capital gain tax calculation. So he's still net ahead in this particular case by $10,000 claiming that Division 43 depreciation building write-off.
So I'm just pulling this out to a larger picture now of maybe someone that's held for 30 years. And I'm thinking the same kind of thing would apply, but then obviously on a larger scale, because now we've got a full depreciation schedule of 30 years completed. But if that was on a property that maybe they bought for $100,000 in the 90s, even though they'd have to pay it all back, I'm thinking of the way that inflation kind of makes the part that you have to pay back almost a bit irrelevant.
Yeah, it is, because remember, you're using that benefit at that value of the
That's what I
dollar,
mean.
and then you're having to pay it back at a far substantial diminished value of dollar, because as we all know, cash diminishes over time.
Yeah, like I think right now about getting like a $50,000 tax bill, and it's like, oh, that's a bit meh. But in 50 years' time, a $50,000 tax bill will probably buy me a Big Mac. Well, not quite, but so if I could get that benefit of 50 grand now, even though if I have to pay back all of it, a portion of it, but in such a long time down the future, there's still a lot of benefit to it.
Absolutely.
Yeah.
So many people that say, well, I don't want to claim it because I've got to pay it all back at the end. Remember, you're only paying back half of it in the end, because we get that 50% discount in relation to the add back of the building write-off.
And I guess you're never doing a depreciation schedule if you're only holding it for 6 months. If you're doing a flip, you're not going to do it.
No, not worth it.
Yeah.
No.
Okay. All right. What about inheritance? If someone's given a property through way of inheritance, do you still have to pay capital gains tax?
So the answer is potentially. There's some time limits involved. So for argument's sake, if your parents have passed away and that was their own home for a long period of time, you've got up to 2 years to be able to sell that property for it to remain as a CGT-free asset.
Out of interest, does it make a difference if it wasn't mum and dad? Like if the guy at the fish and chip shop just really took a shine to you?
Oh, no. So if it's not mum and dad and the fish and chip shop guy really loved you that much and you bought his fish and chips every day after school, if it was always his principal place of residence being used, then you've got up to 2 years to be able to make a decision to say, hey, I'm going to sell his old principal place of residence after I've inherited, and I can still get the capital gain tax-free exemption.
Okay, now fish and chip shop or mum and dad aside, I just heard you say then if it was a principal place of residence. So what if it's an investment property that you're inheriting?
So it's an investment property you're inheriting, and that property has been owned after the pre-CGT date. So let's say for argument's sake, the fish and chip shop guy or mum and dad, they've moved on and you've inherited now their investment property.
Yeah.
You inherit their cost base.
Okay, talk me through this a little bit more.
So if mum and dad, fish and chip shop guy in this particular scenario, bought that property for $150,000 back in 1990, and today in 2023 it's worth $1 million, you actually inherit the cost base that they bought it at. So if you sell it for $1 million, you as the person who's receiving that property as part of the inheritance, you'll be paying the capital gain tax on that property based on the $1 million sale price less the $150,000 cost base. So one of the main things that I see as an accountant, especially when inheritance comes into play for properties that have always been an investment property, is that there's no collection or recollection of the cost price. And that's why estate planning is so important. And I really encourage a lot of clients and a lot of my clients to do their estate planning all the time. Have the efficient records, have the dates of which the property was purchased, the price, have all the information there. Keep it on a file, whether it's soft copy or hard copy, because it's now no longer your problem. You're not here to worry about it, but the person you're leaving it to has to potentially pay a lot of money to all the professionals to go back and collect all that data.
So in that situation, someone's just inherited a property, mum and dad bought it. I don't think the fish and chip shop's going to happen, but mum and dad bought it for 150 grand. It's worth $1 million now, and the kids end up selling it. What if there's multiple people there? Because I'm looking at just in my notes, there'd then be $850,000 worth potentially that would have CGT event triggered on.
Correct.
I'm assuming the 50% discount is applied.
50% discount is applied because, again, you're inheriting the cost base and the overall transaction itself.
And what if it's your brother and your sister and they both inherit the property? Does that then get chopped into $425 each?
It will get chopped into $425 each, correct. Because as part of the will, mum and dad left the property 50-50 to the kids, and the kids now inherit that $425, and they'll also get their 50% discount on it as well.
Now, out of interest, what if mum and dad left you a property, exact same deal, 150 grand, $1 million value now, there's two siblings, but it was in a trust?
So there's a concept called what they call a testamentary trust, and depending on the way it is. So if they pass away and inside their will they said, we create a testamentary trust, of which that property then moves into that trust, and then the children sell it, still the same thing applies from a cost-based perspective.
Yep.
If the property was in a trust, now again, there's a misconception out there. You can't will away a trust. You can appoint a new trustee. You can appoint a new appointer as part of your will.
So what do you mean by you can't will away a trust?
You
Do you
can't
mean you
say,
can't give it away?
Yeah, I give my trust to that person. There's a specific way of doing so where you need to appoint a new appointer, a new controller, and that controller has the right to appoint a new trustee. But nevertheless, the same concept applies. If it's in a trust, that cost base of 150 still stands, and therefore the capital gain tax needs to be paid on behalf of the beneficiaries who are receiving the distribution from that trust.
Just in case if anyone is about to inherit a property, is there anything else that they need to know, be aware of, can control to try and minimize that from that scenario?
Yeah, so the history of the property itself, so actually really understanding what was paid for. Did they do any significant renovations during the time that have added to the cost base? You know, mum and dad bought the property in 1990. They did a $150,000 renovation.
What if you can't find any proof of that?
And that's where the tricky thing is, right? If you can't find any proof of that, you've got things that you can utilize, say potentially like the indexation method for properties that I believe were purchased after either 1997 or 1999.
Okay.
Sorry, before 1997 and 1999.
Yep.
But if you can't apply the indexation method to the capital gain tax calculation and say the property was purchased in the early 2000s, we can't claim it as a tax deduction. We can't claim it as a capital gain reduction, I should say.
Okay, so if mum and dad aren't keeping good records, just give them a little bit of a nudge and say, Mum, can you keep some better paperwork?
Absolutely.
It's going to cost me a lot of money one day.
It's called estate planning.
Planning.
And it's one of the things that it does potentially cost a little bit of money, but my argument to people is what's peace of mind worth?
Yeah.
And what's the impact to the future generation? Because one of the main goals is when you do pass it on, you pass it on with the ability that there's a dynasty that can be created off your legacy.
I don't have any intention of selling. I've sold one property once. It was because I believe it was a dud purchase. It was a unit. I've talked about it a few times on the show. And I don't have an estate plan. And I keep talking about, Bianca and I don't have little people yet, but we want them one day. We're trying. And I want to know that there's something that's created for them. How do you start that process? Because I feel like, not a hypocrite, but I feel silly always saying like, oh yeah, I'm building it forever. It's for future generations. And I don't even have this in place.
Yeah. So obviously keeping really good records is first and foremost, right? Keeping all the records of the purchase and keeping a very detailed understanding, keeping very detailed numbers and spreadsheets and all those other things of the duration of your ownership.
Okay.
So for me, every time I buy a property, I've got a great Excel summary that I create to capture all the cost-based items. And I'll go back and change that Excel summary depending if I've done any renovations. I'll update what depreciation that have been claimed. Keeping records of all your tax returns is key.
Okay.
Especially if you've been keeping, people say that you only need to keep the records for anywhere between 5 to 7 years. I actually disagree and say if you've got investments, your goal is to keep those records for as long as you possibly can.
Yeah, okay.
Because it tells a story. And it's the person who picks that book up needs to also understand the story that you've been telling for, say, the last 20 years.
So estate planning isn't necessarily sitting down with an accountant and going, okay, we're going to set up an estate plan the way we'd set up a trust or a company. It is literally just keeping diligent records.
Absolutely. So when we've done some estate planning for clients, we've got together about 10 folders and put it all onto USB, and it's been where their bank accounts are. You know, what passwords they've got to, say, their internet banking or their ComSec or NAB trade accounts. It's all the settlement statements of the properties that they own, the depreciation schedules of the properties that are attached to, you know, what they've been claiming over the last 10 or 20 years. It's really just putting their whole life out. So rather than people keeping all this stuff in their head, they've created a document, an estate plan of absolutely everything that they have. So when the next person goes to pick it up, they've got a full recollection of events. Death is one of those things that we never plan for. We just think that there's a funeral that needs to be done, but generally it's a lot of money for solicitors. Like I know many solicitors who have bought many Porsches off the back of doing all the work for a deceased estate, which absolutely had no estate plan attached to it, and the solicitors having to spend all this time to capture and collect all this data.
Which is why I've sort of drilled down on this part a little bit more, because I feel like I've kind of taken us off CGT, but I'm doing it in a roundabout way to pull us back onto it, because the next question is how to reduce or not pay CGT if there's anything we can avoid it. But right now, if you are like me and you're building this for future generations, and maybe you're just as ignorant as I've been and haven't actually been doing one part of it properly, then it's the CGT that you're potentially not going to have to, or not yours, it's the CGT your family aren't going to have to pay, which is why I wanted to drill down on that part, because there's no special degree, there's no massive course, there's no anything. You are literally talking about keeping good records.
Absolutely.
Which, if you've got the skill to buy an investment property, you've got the skill to keep good records.
That's it.
I have to outsource that to Bianca, though. I know I'll get bored doing it and I'll stop it, but she will keep good records. But anyway, but now getting towards the end of things, mate, how can people either avoid paying CGT or just try and reduce it as much as possible?
A lot of people are educating themselves on it, and I'm seeing more clients becoming more aware of capital gain tax. We'll start with one common one, which is the 6-year rule. If you've bought a property, you've moved into it straight away, it was your genuine principal place of residence, you've done all the normal things, kids went to school, and you decided that, hey, I want to move out of it now and I want to go rent for lifestyle purposes somewhere else.
Okay.
You've not nominated another home as your principal place of residence. You can't have more than one principal place of residence at one time. And you decide that you want to sell that property in 2 or 3 years after you've rented it out for 2 or 3 years. That means that you can apply the 6-year rule, because when you moved into a new premise, it was not your principal place of residence. It was a rental property that you're paying rent to somebody else. You rented your old home out, and therefore when you sell it, you can sell that property capital gain tax free, even though that you have rented out for the last 3 years.
Gotcha. All right. I got a little bit of a spanner to throw in the works. Couple gets together. Okay. They're de facto. They've been together for a couple of years. Both own their own PPRs. They don't live together yet. They get married. They move into one of them. What if they were to sell both of those properties in the same year together? Do they both get CGT exemptions?
So it's a really good question. So when they get married, that's a legally binding contract, as we all know, and a union between, two people.
Yep.
Once they move into one person's house, they can't continue to have their own principal place of residence moving forward. They've nominated now the person's house that they moved into as their only PPOR.
And so the 6-year rule doesn't apply.
The 6-year rule does not apply, because let's say, for argument's sake, the man in this particular case has moved into his partner's home now.
Yep.
After they've been married. Therefore, he now loses the exemption of the principal place of residence moving forward of his home, because now they've nominated the home that she owns as their new PPOR. So he still gets a proratement exemption for the time that old home was his PPOR, but moving forward, there's a proratement of CGT that he will have to pay.
So in this scenario, the guy would be better off selling first if he had the intention of selling and then getting married.
Correct. Or he's got the option as well, if he wishes to doing a property valuation at the time that he moves out of his own home.
Yep.
Because it was always his principal place of residence. He's now decided to potentially convert it to an investment. He can do a property valuation by a registered property valuer. A real estate agent,
not an appraisal,
is not a registered property valuer. That's a market appraisal. That's an opinion.
And not one of those auto vals on realestate.com.
Correct. It needs to be a full-blown report, very similar to that you would receive from a bank when you're purchasing a property. And that registered property value at the time that he moves out now becomes his new cost base. And therefore, if he was to sell it at the same price of that registered property valuation, there would be then no CGT. But if he sells it for more, there is CGT above and beyond that registered property value that he received when he moved out.
Would it make a difference if they never got married?
Not necessarily, because now we've got rules of de facto.
Okay.
So it can still be seen a de facto relationship in the eyes of many courts that you are a couple, and therefore can be applied from a capital gain tax point of view as well, that was actually his principal place of residence, the new one he's moved into with his partner, because of their relationship status.
Okay. All right. I've got a feeling that there's someone listening to this right now that's just got married and gone, oh, crap, I didn't think of that, and we've just moved in together.
You can't have two principal place of residence. So, many people unfortunately believe that they can, but in this particular case that you can't. You've got one person in that couple, unfortunately, will lose their status of PPOR.
So on the good side of things, though, the 6-year rule, if you have had it as a PPR and then you've moved out, it's become an investment property, whether you're single, de facto, married, whatever it is, you can nominate that as that one property that is then tax exempt from CGT.
Correct. For a period of time of 6 years from the date that you moved out.
Okay. But if you move out and you keep it for another 20 years, do you get 14 years less exemption? Or
you still get the 6-year exemption.
Yep.
You can restart it by moving back, but let's say for argument's sake you didn't.
Yep.
You did not move back and you continued to rent for those 14 years. You still get that 6 years as a proratement CGT exemption. So therefore, you've got to take into account the remaining 14 years over the total time of ownership of that property to calculate the percentage of capital gain tax that needs to be paid.
Mate, perfect. Is there anything else you can think of, or a common question that you get asked about capital gains tax that you think people would gain value from understanding with more clarity?
Yeah, so we're all here, we're all trying to reduce tax where we possibly can legally. So what I really try to advise clients, if financial circumstances allow for it, is that we try to look for deductions. Now, let's say we've done the calculation for CGT on that particular asset and everything's perfect. Well, what other ways that I can utilize to reduce that tax? And this is where we start to use what they call after-tax contributions to super.
Okay, expand on that.
After-tax contributions to super. So with the profit that you've made from the sale of the property, you might want to give a little bit extra to your superannuation through what they call after-tax methods. So it's money moving from your personal account into now your super fund, whether it's self-managed or industry run or retail run in that instance.
Can we go back to Tim's 100 grand a year income, $500,000 sale, 100K profit on the sale? So if he put, he could elect to put 20 grand into super? Or?
Yeah, so he can elect to put up to the cap initially, which is $27,500, but it's based upon what he's already contributed potentially via his employer or any after-tax contributions that he's made in the past during that financial year.
Okay.
So let's say, for argument's sake, his employer's put in $11,000 based on his $100,000 salary. Because superannuation at present's 11%, going up to 12%. So that means on that $11,000, he has the ability to put in a further $16,500 to get him up to the 27.5 cap.
Gotcha. Okay.
So that's $16,500 that he contributes into super, with a notice of intent to claim form, which is telling your super fund that I want to claim this superannuation contribution as a taxable contribution. He gets a tax deduction in his own name, and therefore he has to pay the 15% tax in the super, but the net difference could be quite good. It could be anywhere between 25 cents at its highest benefit and could be as low as, say, potentially 15 cents.
Yeah, that's brilliant.
But nevertheless, there's a substantial benefit. There's a bit more. Now, during COVID, and that was during the Morrison government, he allowed for what they call a 5-year carried forward concessional superannuation contribution rule.
Such a catchy title.
Whoa, 5-year carried forward concessional contribution rule. Now, what that allowed you to do is it allowed you to go back up to 5 years, including that financial year, and top up all the remaining superannuation cap balances that you had left.
That's huge.
For massive people, massive. So for some people, they've been able to get $40,000, $50,000, $60,000 into super, get a substantial amount of tax benefit from the sale of their property. So essentially they've moved the wealth that they've created in their own name, now moved it into a far better tax incentive entity such as super, and they've been able to get a substantial amount of tax benefit on the dollar by doing so.
Can you say the name once more?
5-year carried forward concessional contribution rule.
Okay. I just think it's so important. It's still not stuck in my head. 5-year carry forward concession super rule.
5-year carried forward concessional contribution rule.
Okay. I feel like we're turning it into a sales pitch, but I just want people to remember that because I think that could benefit a lot of people in a big way. Huge benefit.
And again, I always try to encourage people that my wealthiest clients fight with me on how to get more money into super.
Why do you think that is? Because I'm terrible with this, and I'm the first to admit it. I need to fix up my super. You and I have talked about this off air a few times before. I keep looking at it as like 60-year-old Todd. Like I look at the property and the portfolios that I've built and I kind of go, yeah, but I've got control over that now. I can do stuff with it. But you're saying that your wealthiest clients are like, no, that's not my mindset, mate. I put as much in as I can.
Absolutely. They fight every tooth and nail, with every dollar that they have to try to get into super. And the reality is that superannuation was set up to assist the government with the burden of pensions. It was getting people to be able to put money away in a tax incentivized way to help pay for their retirement. So we've got a 15% tax rate on concessional contributions and earnings prior to pension phase, is what they call accumulation phase. And we've got a 10% tax rate encompassing with a 1/3 discount. So essentially 10% tax rate if we sell an asset in super and we've held it for longer than 12 months. So number one, that's fantastic. 15% and 10% if you meet all the conditions tax rate wise. Up to a cap, I think, of about $1.7 or $1.75 million. It's 15% tax. Well, no, apologies, I'll have to recap that. Up to $1.75 million. Once you're in pension phase, that's tax-free.
Okay.
So the earnings that you generate on your balance of $1.75 million or below, and I'll just have to double check that. It does move and does change with indexing over the years.
Approximately
1.75.
Yep.
That means any earnings you generate while in pension phase, so at pension age, tax-free. So if you're generating 10% return on $1.75 million worth of super that you've built up, that's $170,000 worth of income tax-free as an annuity.
That's huge.
If it can continue to obtain that. Now, if you do have $2.5 million in super, then there is a 15% tax rate on the earnings of the $2.5 million less the pension cap, which is, say, give or take, as we mentioned, that 1.75.
Gotcha.
But even then, 15% is far substantially less than if you had that earnings in your own name, which goes through the marginal tax rate system of 19 cents, close to 30 cents, 40 cents, and 45 cents.
So for anyone that's listening to this thing and they haven't talked about selling property in your super yet and how CGT applies, and now that we're on the now that we're on the discussion of super, if someone did buy an investment property and then let's say that they did it in their 30s and then they held it for a long time and they're now coming to sell it, does CGT apply to that?
In super?
In super.
In super. So if they're not retired, yes, capital gain tax will apply to that property that's held by the self-managed super fund in this particular instance.
Okay, but if they are retired?
If they are retired and after pension date and let's say they've transformed their fund now from accumulation phase to pension phase.
Yep.
And let's say they're under the caps, then there is no tax.
No CGT. And now when you say if they're retired,
so
that's not if you can retire. That is if you're past 65, is it?
There are some rules which allow you to pass work tests, and everyone's circumstances are very different. But for argument's sake, let's say you have retired.
Yep.
You've converted your self-managed super fund into pension phase, and you're below that threshold cap. And let's say we're talking in today's terms, as we mentioned, give or take $1.75 million, then the sale would be tax-free. So another reason why, again, a lot of the wealthiest people will fight to try to put as much money into super as they can, because they know that if they do hold that money in their own name, or even with the best structures that we currently have in place, there'll still be more tax as a percentage compared to super.
I'm probably just trying to make myself feel better for bad superannuation decisions, but out of interest, are these wealthy clients that are in their 50s that are looking at 65 going, that's not far away? Or are these still your wealthy clients that are in their 20s and 30s?
Mostly the wealthy clients that are probably 35 and above.
Okay. All right.
So
I'm in that bracket. Yeah, I'm just making bad decisions, Jeremy. All right. We need to talk about that off air, mate. But look, thank you so much for jumping on the show today. I feel like you've brought so much clarity to capital gains tax, when it applies, when it doesn't, the amount of different parts to this machine that attach into it, but then how you can handle them to best reduce it as well. But mate, are there any final words of wisdom or anything you wanted to add into this one before?
Yeah, I'll just give a little bit of a gold nugget. Timing of when you sell the property is very important.
Okay.
So if you engage into a contract to sell a property, contracts exchange, the date's been done and it's 29th of June.
Yeah.
With an accountant, you have up to generally the 15th of May the following year to lodge your tax return. So if you were to sell, let's say for argument's sake, sell the property on the 29th of June 2023. Contracts exchanged, been signed, 29th of June. Therefore, the tax payable, the capital gain tax payable on that property would be on the 15th, before the 15th of May 2024.
Yep.
Now, if you sign the contracts on the 10th of July, for argument's sake, the tax payable, again, if you're lodging through an accountant, is not due until the 15th of May 2025.
Because so you get to hold on to that money for an extra 12 months,
correct,
essentially.
Correct. And that what that does allow you is potentially to make some earnings, and it could be through reduction of interest if held in an offset account, or you might be clever enough to try to make some more money on top of that money, which is the tax office's money, in the interim. So accountants will often try to time an event if we possibly can. But one of the risks of doing that, and I always identify that with a client, is that if you've got a very hot buyer who wants to sign that contract, sometimes it can be a very big risk trying to stretch that out another 10 days. So it is a tango, it is a dance that you need to play with that buyer. But ideally, if you can, sign a contract, and contracts are both signed after the 30 June cutoff date, then that gives you the opportunity to pay that tax in a lot longer time frame.
Biggest thing I'm getting from that as a takeaway is if you're looking at selling, you might be triggering a capital gains tax event. Talk to your accountant first. Don't just go, okay, we're going to do this, make some decisions that are contractually obligating you to follow through with them, and then get advice. Always the other way around.
Absolutely.
All right, Jeremy Iannuzzelli, thank you so much for jumping on the show again, mate. I'm sure we'll see you again soon.
Pleasure as always. Thank you, Todd.